and the Civic Exchange for organize the event. PwC, who I don't think I ever mentioned you, actually was the first outside auditor for the Chicago Climate Exchange, and I had the privilege of working for, in 1998, as the advisor on greenhouse gases. So I couldn't be in a better place with a sponsor like Civic Exchange, PwC, and a kind introduction from David. Financial innovation has come under a lot of criticism recently. Paul Volcker said that he thought the most important financial innovation in the 20th century was the ATM. Not exactly a ringing endorsement of finance. Joseph Stiglitz basically said that he thought that he could find no value whatsoever in complex derivatives. While I have the highest regard for both of these first-class people, I do have to challenge them. Why the bad rap? Everybody in this room, anybody who hasn't heard of Henry Ford? Everybody know who Henry Ford is? Yeah. Anybody know who Luca Pacioli is? And he's not the lead character in The Godfather. Doesn't sleep with fish. There was a hand up there, which is, and I've only had two hands, and I've been at Yale and West Point, University of Chicago, but yes, sir?
Can you come up with the first accounting principles in the 16th century?
Actually, he was in the Venetian and the Renaissance in Italy, the inventor of double-entry bookkeeping. So the notion, and I would argue, and put forth a hypothesis, that he, in doing that, enabled the Renaissance, the Medicis, banking at the time, and probably added more value than Henry Ford did. So why is there little recognition of financial innovation? For several reasons. Number one, it's a wholesale product and not a retail product. It's not like Ford or a cosmetic or something that is used by the popular. That's number one. Two, it tends to be collaborative. People build on it, and individuals don't typically get associated with a financial innovation like the camera, Polaroid, things like that. And third, up until recently, it has not been patented. So if we take a look at those reasons, financial innovation is put to a background. Among the financial innovations that I think are most important have been derivatives. So first of all, let's ask the question about what is a derivative, then what is a good derivative, and what is a bad derivative. In the 1970s, when I was working on Ginnie Mae futures and bond futures, somebody said, how would you describe them? And I said, I think I would call them, excuse me, derivatives, because they are derived from something else. So a treasury bond futures is derived from a treasury bond. Corn futures are derived from corn. So there's an underlying, and think of it as the calculus where you take one thing and derive something else. A good derivative is one that is transparent, regulated, and carries no credit risk because it has a central counterparty and offers price discovery. Now, what's a bad derivative? Let me give you an example of one. Greek debt. And CDS is on Greek debt. In 2007, you could buy insurance on the government of Greece defaulting for 27 basis points, 0.25%. Ken Rogoff at Harvard points out that every other year from 1829 until 2007, Greece defaulted on its debt. 50.6% of the times, and yet the price of insurance was 0.25%. There was no margin, it was opaque, and there was no credit guarantees. And this is what helped participate the decline in 2000 and 2008. Good derivatives, the Chicago model that started there, basically have grown rapidly. They were an American product, essentially in 1975, very little done around the world, but from 1970 until last year, exchange-traded, regulated markets grew at a compound growth rate of 18% a year for 40 straight years. The only thing that grew more quickly in America, other than regulated derivatives, were technology and chip capacity. So this was remarkable. And in 2007 and 2008, in 35 countries and 78 separate derivative exchanges, not one of them had to be bailed out. There was no TARP money, there were no defaults, they caused no systemic risk, and as a matter of fact, have become the model for financial reform in both Europe and the United States. So these are to be imitated and not demeaned. The drivers of these growth, essentially, as David pointed out, were as new products. In 1970, there was no foreign exchange trading, there was no stock options trading, there was no interest rate futures. None of those products existed, and moreover, energy, natural gas, heating oil, crude oil, there were no markets. So virtually all of that growth occurred from the introduction of financial innovation over the time period from 1970 to then. The market cap of exchanges, just the US CME, ICE, and the CBOE, 3 exchanges, roughly $33 billion. Just to put that in comparison, the top 5 US airlines have a market cap of $24 billion. So regulated exchanges just in the United States are 50% bigger than the airline industry. That's not the value. The value comes from the ability of companies, firms to hedge, that is, transfer their price risk from one party to another. The price discovery that occurs, that is, a farmer can take a look at a price and decide whether they should plant, he or she, soybeans or corn, just based on next year's futures price. So price as a signal allocates the entire world production of food and feed grains, even if companies or individuals never use it. So the price discovery is important. The third issue is the transparency. And the transparency basically drives the bid and ask, the wholesale retail price to very narrow levels. And so farmers are better off, processors are better off because of the fact that the spot markets benefit from showing what price is directly and what can be extrapolated around the world. So, let me make a controversial statement. To have this efficiency, you need speculation. Okay? You need hedgers, people who want to get rid of the risk, and you need speculators. And I would hypothesize speculation is a good thing if it is done properly and regulated. Okay? And very important distinguish that from what goes on in Macau. Okay? There is no risk until you build a casino. Okay? There is no risk until you build a racetrack. Soybeans go up and down, interest rates go up and down, corn goes up and down, copper goes up and down, whether or not you have an exchange. And the question is, who takes that risk? And it's very important to recognize there's a vital role. In another world, you would say speculation is obviously good in the following context. The people who funded Apple, right? Stephen Jobs was willing to take the technological risk. He didn't want the financial risk. So he transferred that and gave it away to private equity owners. So it seems in the context of developing whole new industries, telecommunications, search engines, Facebook, all of that was developed with speculative capital. We don't call it that, but there were professional risk takers who took it from the technology creators who didn't want the financial risk. So please recognize that in the proper sense, speculation is important. Now, there was a time, for example, at the Great Viewpoint in the 1930s when speculation was supposedly driving food prices crazy. So then the dictator in Spain, a man by the name of Franco, said, I'm going to get rid of the speculation. And so he called in all of the speculators into the central square of Madrid, and he found a solution. He had them all killed. And it worked, okay? Food prices dropped dramatically, and everybody was happy, except there was a problem. The next year, there was a short crop. As a result of the short crop, there were no speculative inventories, and Spain had widespread famine. So we have to be very careful about how we view speculation in the context of it. I want to talk to you briefly and just hit through some examples about speculation, good derivatives, what's gone on. Right now we have a major drought going on in the United States. We have the shortest crops that we've had for a long time, since the 80s. There's no problem about food prices. They've worked out well. The markets have directed farmers to produce what they can. In spite of the shortest crops, Americans will spend less money, disposable income on food than they've ever spent. It was 25% in the 70s. It's down to 12 to 15% now. And you never hear about anything about these markets. Yet if you go to Beijing and speak to the Minister of Agriculture, they watch the corn prices and the wheat prices and the soybean prices in the United States. All done with good derivatives. Transportation. 2 major airlines, the biggest in the United States, went through bankruptcy. One, Southwest Airlines, hedged all their fuel costs and became one of the biggest airlines in the United States by managing its risk. So that's food, that's transportation. Housing. With the advent of Ginnie Mae futures, the spread between the bid side and the offer side, the wholesale retail spread, the cost of distribution, went from 3/4 of a point to a 32nd. That 3/4 of a point drop resulted in $6,000 less over the life of a mortgage for the average American homeowner, just because of transparency. Next, okay, interest rate risks, the banks. In the United States, when the curve inverted, that is, when short-term interest rates went above long-term interest rates, we lost 5,000 S&Ls, 10 to 15,000 commercial banks, thousands of credit unions. In the crisis of 2007 and 8, not one depository institution went bankrupt because of interest rate risk. The biggest commodity they handled, money, was handled effectively, efficiently, with no risk to the public because the principal product money and its cost, interest rates, was effectively managed. How about government debt? In a 10-year government, which we wrote, and I was privileged to be part of a team that wrote the futures for that, the spread, 1/8 of a point to 1/4 of a point, was prevalent prior to 1982. It dropped to a 32nd and a half a 32nd. What is this man talking about, for those of you who are not familiar with the U.S. bond market? What it means, it cost the U.S. government last year $500 million less in interest rate costs because of the efficiency in the market. And it saved hedge funds, university funds, endowment funds, pensioners, $10 billion in transactions costs that went to retirees that would have gotten sucked up